Hello, I'm Adam Grimes, and welcome to ChartSchool. This is being recorded December 3rd, 2018 in the late afternoon, and the topic today is gaps and reactions and overreactions in markets. A little bit of history. If you're listening to this down the road, you might not be aware of this. We had a big move over the weekend in basically pretty much every market. Here you can see the S&P 500, a sizable gap from Friday's close to Monday's open, and this was driven by some news relating to trade. There have been a lot of trade tariffs, and there's a trade war between the US and China, and some news came out that basically the two sides had agreed to a temporary truce. So how does the market react to this? With a large gap up opening. Now, how do you think about gap up opening? This is a perennial question. Everybody, whatever market you trade, and some markets will gap a lot more. Individual stocks gap a lot. You don't really see gaps in currencies because they trade 24 hours a day. You will see some gaps in some commodities that are closed for a while. But basically, when you see a gap, it means that news came out while the market was closed. So the way we think of a gap traditionally, and this is going back decades and decades in market history, is that it indicates some type of powerful shift and potentially powerful shift in market dynamics. Some new news item has popped up that has changed the prospects going forward, has changed the psychology in the market, whatever. It's some kind of powerful shift. Now, I think one of the things we're going to have to rethink in decades going forward is that trading in markets is becoming more and more continuous. The poster children for this, of course, are currencies, which, because they trade 24 hours a day, almost never gap. You will see some gaps on currencies, but pretty much only over the weekends. There may be some rare exception where you have a very extreme market condition that causes a gap, but you're not going to look at a chart of a currency and see, here's a gappy chart, this is GLD, look at all the gaps. And just to be clear, I think probably most of you know, but the gaps are spaces between each price bar where there's no trading. And here's gold futures, which will magically fill in the gap. See that? So gold futures trade more or less 24 hours a day. So when you see this, and let me kind of reconstruct my thought process over the weekend. I knew this news came out while the market was closed. And so you think, what do I expect the market to do? Well, I expect the market will probably gap up a lot. But what's a lot? I don't know. If you made me guess when I first heard the news, I just said maybe 35 handles. And ended up being 40 and change, and we traded up to 50. And so you expect this move up. Now, what would have happened? Imagine this. Let's say this news comes out that we think is going to be interpreted by the market in a very positive way, and the market does not gap up. People think about this differently. Some people use this concept of, they'll say good news, bad action. When news hits a market and the market doesn't do what it, quote, should, then you take a contrary position. For instance, if something really good about the stock market comes out, like we thought this might be interpreted, and the market doesn't gap up, you get short. Now, that's what some people think, and to be clear, I don't think that's a very smart trading strategy. The reason is because I would almost argue that if we have something like that, we misunderstood the news. Any piece of news could be read a lot of different ways. And one of the things that I discuss with my clients, I said that this trade, the temporary pause in the trade war should be a very positive thing for the market, but maybe not. Maybe people would look at the announcement and say, wait a minute, you didn't actually do anything. You just agreed to relax for a while. Or maybe you could even twist things around in a really strange way and say, okay, renewed trade is going to be great for the economies of both China and the US. They're both going to grow at incredible rates, and the US has already seen very good growth. So if we have those economies growing that fast, maybe they'll almost reach overheat, maybe the Fed will have to raise rates, at which point everybody throws their hands in the air and runs screaming because that's supposed to be some terrifying thing. And maybe the market goes down because of that. You can always find all of these other ways to reason. So I have not really found it to be very productive to try to predict market reaction to the news. There are obvious exceptions. If you trade, if you trade pharmaceutical stocks and some company has a drug approval canceled or denied, and the stock collapses, well, that's a move that was rather predictable. But in general, be careful trying to parse these macro moves too carefully. What you also should expect is that when a big news item hits the market does not react like this. You don't have a market that's moving along here and then boop, goes up to the next level. This is kind of, and this is in one of my books, a diagram like this. This is a very idealized theoretical example. So the new information comes out, people immediately do the math and figure out that the new price should be here, and what happens? We just go there. It does not work like that. What you will see is something like this many times. You'll see overshoots and undershoots, and you'll see that you usually have this burst of volatility here at the beginning, and the true value ends up being somewhere in the middle. And of course, while all of this garbage is happening, new news can hit the market. So it's not quite that simple, It's never like, okay, here's just one thing to figure out. While all this is happening, there's new information coming, and other markets are trading. There are all these other influences. So if there is some theoretical true value, it's also moving around. And the net effect is that you don't know what's going to happen when you may have a big gap up, and it could very well continue. And I saw casually a lot of people, gurus, I guess, talking about how the market was just going to explode higher after this move and how we were going to be higher for all of December. And it may very well happen. But the problem that I have with this is the thought process that you're assuming a gap up is going to lead to some type of very easy further gains. It also is quite possible that you have something like this, which seems to be what's going on here. If I go back to the market, and you can see the 15-minute, and we haven't quite closed the gap. By the way, there's also a lot of stats about gap closure out there, and I think if you do the work on those, that think about it like this. If you have a market that gaps, then assume for a moment that it moves randomly. And I'm not saying that it does, but just enter that mindset that the market moves randomly after the gap. Well, if that is true, if the market does move randomly, we're going to see a lot of those gaps close just kind of by random motion, right? The market bouncing around randomly will close a lot of the gaps. So what we need to see, now you can, I know for many of you that assumption that markets move randomly is horrifically unacceptable. So now you can go back into whatever mindset you wish, but take that lesson. If markets move randomly, then we'd see a lot of the gaps close. So what we need to be able to do, if we really want to focus on gap closure as a tendency, is we need to see that gaps close more often than they would under random walk. And that's quite difficult to prove. In fact, and when I say quite difficult to prove, I mean I don't really see it supported by the data. So I think all of these stats about gap closures, there's just bad math in my opinion. There was a little bit more of a tendency in previous decades for gaps in index futures to close, and I believe it's not something I've updated very recently, but in the data that I've looked at relatively recently, that tendency has degraded so that it's just not there. So what, and I realize this is kind of a rambling deep thought chart school, but I think this is a very important topic. The idea that when you see a big news item hit a market, you must retain the flexibility to not assume one outcome. And I would suggest if you read the news, you have to maintain a sense of humility that says, I don't really know how the market's going to interpret this. I don't know. There are so many competing influences that here's what I think is going to happen. It's fine to have a game plan, but if your game plan was that I think the market is heading higher. Well, you should have seen before the U.S. market opened that this is going to be very different, because look at the 15-minute chart. We don't typically see good bear flags in markets that are just going to scream higher, right? And then we continue to have breakdown all day. So that's something to think about, and also to think about the idea that as we're trying to understand reactions and overreactions in markets, that's a very dynamic environment, and it's complicated by the fact that new information and action in related markets, which brings us to Zoros's idea of reflexivity, where price movement itself is actually having an impact on the fundamentals, that's also something that's going on. So it's a quite complicated environment. As far as what's going on here, well, the kind of the last word that I would leave you with is that technical patterns work. It's very possible that we may have an extremity. And look here. So look at your 15-minute chart. I lived this just like less than a day ago, so I remember this very clearly. You see this gap up, and you don't really know. And so we have a gap up and a sharp drive up on the first 15 minutes. Now, would I have bought this pullback? No, I didn't. Would I have shorted this market? No, I think that would have been suicidal. You just don't know. You could have done either of those things, to be clear, with proper risk management. But what I mean is to have the confidence to say, I have a high degree of confidence what's going to happen. The first place I get a high degree of confidence is here. And as we were watching this develop through the European session, and there just wasn't really the follow-through, this told me before the U.S. market opened that we probably were not going to have a very strong session. Of course, it could have been different. And where it would have been different is if this flag had failed. See, these simple technical patterns, this is the last lesson of this chart school, I promise. These simple technical patterns work with fundamentals, work with news, and work in complicated dynamic market environments. Okay, that's all I have for you today. I'll see you back soon for another chart school. Please go to marketlifetrading.com. Check out everything we have there. Big free trading course, and also have a number of services that might help you with your trading. marketlifetrading.com. Thank you very much.